No, the title of the video is not wrong. I want to get through this screen first while I have a captive audience here, because these are important dates and I need you to put them in your head so you don't mess up. After this screen is over, it is the applied series that I had done earlier in the week. It was posted on Sunday on our site to all subscribers of level 1, level 2, level 3, and to the options course. And I did it as a test. I wasn't sure whether or not anybody would get any value out of it. It was really just, I say in other videos that Sunday mornings is when I reflect on the market and I think about what positions I have and do I need to change anything for the week coming up. Has anything changed significantly where I need to change strategy or do anything? And I go through the process of how I look at the market. So it's an hour and a half coming up of the steps that I take. All the links, and I say it many times in the video, all the links of everything I refer to are just down below in the description box if you wanna refer to some sources. So going forward, I will do this on a weekly basis. The weekly update every Sunday. I'll put out an hour and a half of how I think about things, how I structure my thoughts for clarity, and it's all within the structure of the learning that you'd get at all three levels. It's not a matter of me just going off on a tangent saying I think this, I think that. It's all within a structure. We look at data, and from data there's interpretation. Yeah, mind you, it's my interpretation. You can differ with the interpretation, but it shows you the structure that I go through. So if you enjoy it and you are going to be subscribing to our site, you can look forward to having that in your market applied folder. Sunday afternoon. I think it's best to have it Sunday before the market begins so that you can look at it and see if it coincides with what you believe. Anyways, let's get these dates out of the way because I don't want anybody messing up here, because there are some early registration dates. May 2022, level 1 and level 3 exams only. I have the dates for the exams up here. Registration closes February 8th, so if this is something you're going to do, if you're going to make a run for May, you only have 2 weeks. Being that you only have 2 weeks, there's no point in saying, okay, let me remember that. Hit pause right now and take care of it so you don't forget it. Yeah, it's $1,000 there. And your scheduling deadline is February 16th. So I have heard this before, that somebody misses their scheduling deadline. That's it. They can't schedule and it's over. So, to spend the money and then not schedule. So if you have registered already and you haven't scheduled February 16th, there's no point waiting. Hit pause on the video now and just do it now. Why put something off this important, right? Remember these dates. August, level 1, level 2, and level 3, I have the exam dates here for you. Early registration, okay, you're going to save $300. Early registration closes at midnight on February 9th. So if you know you're going to be taking August, why wait? Save yourself $300. Register before August 9th. After that, it's if you register on the 10th, just for the sake of one day, 24 hours is going to cost you another $300. Standard registration will close May 3rd, and there is your scheduling deadline for that, May 25th. If you're going all the way to November, and it is up level 1 and level 2, there is no level 3. The level 3 was November. It got pulled back to August because they found that getting the grading was difficult over the Christmas holiday. So bringing it back to August, the promise is, hey, we can get you your results faster. Early registration here closes May 3rd. You got some time, $700. But then again, if you know that you are going to be registering for November, may as well get it out of the way now or soon, just in case you missed that May 3rd deadline. Standard registration closes August 9th, and your scheduling deadline is August 17th. I just wanted to get those dates in your head so that if you are thinking about a May and August or November, you know exactly when your deadlines are, especially for August here. It's just around the corner. We're already the 26th of January, so next week we're into February. It's not long. You get to save $300, so let's get it done. Okay, I'll let the applied series play at this point. And just to reiterate, I did say in December that I would put one more applied series up on YouTube and then related to the market, and then after that I would do a different type of applied series for YouTube, looking at more social issues and more legislative issues, government policy issues through the lens of what we learn. And does anything in CFA content at any of the three levels help inform us about policy and about society at large? And I think it does. Different ways of seeing common problems and different ways of looking at them that I think are more rational, more logical, less emotional. I think there's just too much emotion in arguments and debates today, and you can't beat an emotional argument with a logical argument because the other person's not listening. You have to try to put out as much rationality as you can and hope that people abandon their emotion for rationality. Anyways, what follows is just, as I said, the structure in which I think about things for the course of the week. And I'll be doing one of these every week now. And they're lengthy. Because there's a lot to go through, it helps, it gives you a structure in which to think about things. You don't have to interpret things the same way I do, but I think that using this structure will help compartmentalize your thoughts. If you are a full level subscriber to level 1, level 2, level 3, this will just be included in with your subscription. You'll get that every single week. I think it's important to watch as well. Even if you're not in the market, I think it's important to watch because it'll help you begin to connect everything you're learning to the market, and you'll see how it informs your opinion of the market and how these things apply. Some things that you might not think are useful, you'll read something, you go, when am I ever going to see that? I talk in this applied series about, or in this video coming up, we look at a couple indexes called diffusion indexes. This is something you're introduced to at level 1, and you may think, well, this sounds complicated. When are we ever going to use these? Well, I introduce you to 2 of them in the video when we're looking at some of the economic data. So I think it's important to watch it. It does make that connection for you, and sometimes when you can make the connection, it all becomes real. And I've made this analogy before that level 1, any of the levels, if you think about everything that you're doing, is not really another year of university. It's not equivalent to that. It's more equivalent to your first year of your career. It's more like an unpaid internship. That's the type of information that you're learning. It is very applied and very practical with a good dose of academic support behind it, because you do need some structure and some foundation that's based on something that has some relevance or some veracity and knowledge. Anyways, there you go. Okay, I'm going to do a different type of applied series today. In past videos, I've always mentioned that Sunday mornings is the time where I review what happened during the week, and I revisit my assumptions about my belief in markets, so that if I need to change course, I will change course, or that anything new that I do is in line with what I believe. So if I come to the conclusion that we're going down in the markets another 20%, I'm certainly not a buyer. And I want to make sure that the actions I take that week, no matter how tempting something may be, that they are in line with my beliefs. Because typically where you get into trouble is where you start trading on somebody else's beliefs and not your own beliefs. So I'll walk through some of the thinking that I go through, and it's not going to be this linear progression that we go through. We'll jump around quite a bit, but I'll also provide you with a number of sources that I refer to that I find also lead me to other sources, as opposed to just grabbing anything that I see. After a while, you get used to certain certain information sources that you trust, and then if they refer you to other information sources, I trust those links as well. Economic calendars are the best. I don't need to hear somebody's opinion about something. I can form my own, so we'll look at something there as well. So I've drawn 3 circles here: geopolitics, the economy, and the market. The danger with being a market participant is this is the lens through which you see the world, because it's in our faces all day long. We're thinking about it all day. We're thinking about earnings. We're thinking about price trends, all sorts of things, and we end up, because it is our world, we end up seeing the world through the lens of the market. And it's actually the other way around. The world is not a reflection of the market. The market is a reflection of everything else. So I always start from the highest level and I work my way inwards, and I ask, well, is there anything at any level that would cause the behavior that we're seeing in the market, which is the selling? And you try to isolate it to something. You can't just say, well, the economy is going to hell. You want to be a little bit more specific than that. You know, I've heard some people say, well, this is all about the central bank and interest rates. Is it all about that? Nothing more? Or is that just one more thing? I've been asked, you know, what does Ukraine have to do with any of this? And Ukraine doesn't really have anything to do with the move in equity prices at the aggregate level. Typically, when you have geopolitics, you're looking for the effect on commodities. Which commodities are going to be affected? We have always had geopolitical tensions. It just depends on where those geopolitical tensions are happening. And if there are no commodities involved, or no supply of commodities involved, we tend to simply just ignore those geopolitical tensions. So there are some countries that are, torn with civil war, but we don't care about them, or at least, you know, if you listen to the media, there's very little concern about those countries being expressed, simply because it doesn't affect anything for us. There's no commodity effect there at all. So you've got, you know, Ukraine happening right now, and neither side wants a war over this, but both sides need a graceful exit. That's all. If you flip the situation and you say, well, let's assume for a moment that the US actually was geographically where Russia is, and that Russia was geographically where the US was, with the same tensions. Now Ukraine would be on the US's border, and Russia is saying, well, we're going to make Ukraine part of our alliance, and we're going to set up bases in the Ukraine. What do you think the US would say? Not on our border, sunshine. I don't think so. The U.S. would be amassing troops on that border saying, you either keep this country as a buffer between you and us, or we're going in, but you can't have it. The U.S. would be doing the same thing, and I think they understand that. So we can't just look at one side is evil, one side is good. If it were flipped the other way around, the narrative would be different. That's all. So I think the U.S. understands Russia's position. And I think Russia understands the U.S.'s position. And as far as NATO is concerned, I think one of the sharpest analysis that I read on this was that internally, NATO probably does not want the Ukraine anyways to be part of NATO, only because of their credo: an attack on one is an attack on all. So what they don't want is to bring in somebody into NATO where an attack is probably likely, or highly likely, or more probable than any other country, because, well, an attack on one is an attack on all, and Western countries, I don't think, have the appetite for a war, nor do they have the budget for a war. So this will resolve itself, because both sides right now are not, I don't think they're negotiating so much on what to do about Ukraine. I think they're negotiating more about how do we have an exit where we both look really good. You know, what does that look like where we both look really good on this one? And I think you'll get there. As far as sanctions go on Russia, what would we be looking for in terms of effect on commodities? Well, obviously energy is the big one. But there is one commodity that Russia pretty much has a monopoly on. 80% of the world supply of this one commodity comes out of Russia. And if they want to, they can hurt the global economy just as easily as the global economy can hurt them by restricting all exports of this one commodity. You would basically shut down the entire auto sector, and it is palladium. Palladium, the major source right now is Russia. If you look at palladium prices and you go back to 2006, 2007, it was $400, $500 an ounce, and it climbed all the way to over $2,000 an ounce over the last 10 years. And I still think it's sitting above $1,000 an ounce. I used to play palladium. I don't anymore because it's just you have no transparency on supply, on inventories, on level of productions, because it's not widely shared information. So geopolitically, if I'm in the space for energy and palladium, maybe I'm concerned. But if I'm trying to explain the 9% drop in the S&P over the last few weeks, it's not this. It's not this at all. And how this unfolds, I think it'll be tense for a while, but they'll find some solution that works. So let's go to the economy, the level of the economy, and we can look at economic data. We can look at leading indicators, coincident indicators, lagging, not so great, but certainly leading indicators. The index of leading indicators was good. We'll look at an economic calendar here in a second. Building permits, which is a leading indicator for construction in the housing sector and for housing starts, came in very strong. So if I look at the economic data, if I were unaware of what was going on in the market and I looked at the economic data, I could not come to the conclusion, well, the market must have sold off over the last little while. I also could not come to the conclusion that the market must have really rallied, because it's mixed, as all economic data is mixed. You'll never get 100% in one direction or 100% in the other direction. You tend to get like, well, the data sort of leans more towards this way or leans more towards that way, but it's never all conclusive just on one side. So you have to, interpret these things, and leading indicators mean more than coincident, and coincident mean more than lagging indicators. So if you're going to tell me what happened in in December, okay, I have to tear that apart with what other things happened in December, and Omicron was a big thing everywhere. So if you tell me retail sales were bad in December, I would say that does not surprise me. If you say that housing sales were low in December, I would say that does not surprise me, because at the margin, something like all the news on Omicron will keep people in their homes, and that's enough to cause a difference in the number that we would see. So you got to pull that stuff apart, right? And we're in January. We can look at leading indicators, and we'll look at a few leading indicators. They don't suggest that the market should have corrected by 9%. So economic data, I'm not really that concerned with. Demand is strong and growing. There is no lack of demand. One thing that I always rely on is just the pattern of human beings. 70, even up to 80% of consumers spend every penny they make. If you give somebody, the average person on the street, if you give them $10,000, their first thoughts are, what can I buy? Not what can I invest in, but what can I buy? Typically, if you give somebody in the top 10% or the top 5% an extra $10,000, their first thoughts are, what can I invest in? From the 70 percentile on down, if you give them 10,000, very rarely, it would be the exception of them saying, what would I invest in? Typically it's, I'm going to go to the mall. What do I need? What am I going to buy? What do I like to have? So when we think about fiscal stimulus, giving money to the top 10% makes no sense at all. None whatsoever, unless you're trying to encourage investment. But if you're trying to encourage demand, you want to give it, like definitely to the bottom 50% because it's got a huge multiplier. Well, what have governments been doing? Paying people to stay home, extended unemployment benefits, emergency. In Canada, we have something called a CERB, which is the emergency response benefit. Some people, I think there's still some checks going out every month. I say checks going out, but money being deposited in accounts. Pay people to stay home. You know what they're going to do? They're going to stay home, and they're going to spend it. Demand is good. Here's your problem. But there's been a problem for a while, and we know it's a problem, is supply. We don't have a shortage of physical capacity. Let's be clear on that. Our supply problems in the world today are not a problem of, well, we need to build out more physical capacity. It is human capital constraint. There are way more job postings than there are job seekers. And wages are going up, which is a good thing, by the way. If you're going to have 4% inflation and you can explain 70% of that inflation because of wages going up, great. Because like I just said over here, most people will spend every penny they make. So if you give them more money, they will just spend more. Higher wages mean higher demand. So I'm not concerned with wage inflation being a jitter for the market. You can say that, well, it's going to raise expenses for companies. Yes, it'll raise expenses for companies, but they're going to get more volume out of it because if you give the American population another $1 billion in wages, they will go to the malls and spend another 900 million of that $1 billion. So you'll have that multiplier effect, and when they spend that 900 billion, other people will get it and they'll go out and they'll spend 810 of that billion, and on and on. So when you have a multiplier and you have a population willing to spend almost everything they make, giving somebody an extra dollar ends up being much more value to the economy than the corporation making an extra dollar in margin. So what you lose in margin, you make up in volume. Maybe it just takes a little while for the market to figure that out. I'm unconcerned about wages. But this is the cause of our inflation. If you think it through, it is a lot of supply problems. This last January or September that went by, typically every September, you can't go anywhere without being hit with an ad from the auto companies. Employee pricing, no 0% financing, $10,000 rebates, all of these incentives to get you on the lot because the new models are going to be hitting the showrooms in the next few weeks, and they got to clear out their inventory through a purchasing invoice error. I have 100 of these too many. I've got to get rid of them, and I'm doing it at cost. How many of these have you seen, right? Did you see them in September? No, because the auto companies can sell every single vehicle they make. Every single vehicle. GM sold out of the Silverado. It's not even being made yet. They sold out in 12 minutes. Ford sold the F-150 Lightning in 4 minutes. And not cheap. Silverado was $105,000. That's for a truck, US, $105,000. So that's $130,000 in Canadian dollars for a pickup truck, and full margin. And if we understand auto companies, we know they have huge fixed costs, low variable costs. That's huge operating leverage. All of that goes to the bottom line. So I think earnings for industrials and especially companies that have high fixed costs like that will be fairly good. So we don't have a demand problem. You have a supply problem. What's holding back the supply of vehicles? Why is it like that? You got a chip shortage. All right. So that brings us to fiscal and monetary here. We're going to go into more detail on all of these. I'm just sort of giving a high level, verbal thoughts as I'm thinking it through. I'm just speaking my thoughts without any kind of, structure. I'm just really, imagine you're just listening to a long conversation where you asked me a question and I went on for way, way, way too long. The fiscal side, yeah, looks like we have a problem there, is that the last Build Back Better bill is not going to get through. I say a problem because if it would have gotten through, it just meant more spending, but it also meant more debt and potentially higher inflation at the same time. You can pick a better time to pass a bill like that when everybody's fighting for product, and everybody's fighting for labor, and everybody's fighting for materials and service. I think, Mr. Government, you could pick a better time to sort of crowd consumers out of certain markets, right? So I don't know that it's such a bad thing, but maybe the market is interpreting as a bad thing. I think some components might pass in smaller bills here and there, but that thing I think is dead, which I don't know would be enough on its own to cause this thing going on in the market. That brings us to monetary. And this is the problem, is the monetary. We started with a Fed that is saying, hey, it looks like, in December, we're going to have to pay attention to this inflation thing. So let's cut back our bond purchases. The market doesn't need this. Nobody really cared about that. But then the narrative started that, well, that makes the first rate hike probably June, maybe even as early as March. And you're probably going to have 2 to 3 rate hikes in 2022. I'm going to write this down so that you see what's going on. If you've been listening to the business media, you would have seen the progression all on its own. I don't know if you've ever played this game where people sit in a circle, right? And then this person whispers something to this person, who then whispers the same thing to this person, and then finally it gets around and this person whispers it back, and it's never the same thing that the person said. It gets interpreted and changed and magnified all the way around. So in December, there was a cut in the bond purchases, and the thinking was, okay, well, your first rate hike is going to be somewhere March, June, and by March, maybe we'll be out of bond purchases altogether with the rate hike happening in June. And maybe we're looking at 3 rate hikes in 2022, which soon became, we will be done in March, and the rate hike will probably happen in March as well, and we're looking at maybe 4 rate hikes over the year. Which then became, January will be done the purchases, and March will have a rate hike, and it might even be as high as 50 basis points. And we're looking at 5 to 6 rate hikes over the course of the year. To the last round that I've heard is January. They're going to announce the end of all the bond purchases. We're probably looking at 25 basis points here and 25 basis points on each meeting, and we're looking at 9 increases over the course of the year. We've gone from something reasonable to something absolutely unreasonable, and it's that unreasonableness that keeps getting priced into the market. I just don't see this as the scenario. If you think about inflation as being a combination of supply and demand, right now the biggest part of inflation is supply. Raise interest rates all you want, you're not going to fix that. And I'll give you a story. We have an IT office in Toronto. We can't find IT people, and I've worked my whole network. I've called people I know in the industry, companies I know in the industry, and everyone is saying the same thing. Yeah, stand in line. In fact, some of them aren't even sharing information with me that they used to share. One company is outsourcing to Colombia. Well, who are you outsourcing to? Silence. Won't even tell me the name, for fear that I may outsource there and then suddenly create a supply constraint. And if everybody knows about this company, everyone will be using them, and then they'll be screwed. So you can't even get information out of people. Raising interest rates is not going to change that. You have to continually outbid and outbid and outbid. Well, our IT office is in Toronto. Which is not a small pond, it's an ocean. And in that ocean are big fish. We cannot compete with the big fish. We don't have stock options. We don't have the name cachet. You don't have that little placard that they can wear to the clubs at night saying, I work for Google, I work for Microsoft, I work for Etsy. Don't have any of that, right? And we're not alone. some of the other companies, even mid-sized companies, have IT problems where they've shelved certain projects because, well, we can't get people, so we have to pull back and just focus on what we can do. Raising interest rates is not going to solve that, and the people at the Fed are well aware of that. I'd go, if I had to weight them, I'd say our inflation problem is 75% supply and 25% demand. And of this demand problem, I'd say the fiscal is probably responsible for 20% of it on their own. Stop paying people to stay home, because you're creating a source of demand by giving them money, and you're constraining supply because they're saying, why should I work? Why should I go out and earn money if I'm going to get money? I'd rather get money than earn money. So this I think has been, this whole situation we're in has been institutionally engineered by the fiscal, and the monetary, I think, has a problem with all the liquidity they pumped in. They should have been cutting back those bond purchases a year ago, really, when it looked like the economy would bounce back if you let it. So I want you to think about supply this way. Imagine there's a river going through a particular town, and this is the beginning of the town, this is the end of the town, or the region, whatever you want to refer to it as. And there are people on both sides that rely on the water flowing in that river. There are two things that would be a problem. Number one, a whole bunch of people start moving into this region, and the water flowing through is simply not enough. Well, that's a problem of demand. That's a problem of demand. But let's say that way upstream here, a big dam was built on the river coming down here, trickling down, and all of a sudden you had a trickle of what the river was. Would you say, oh, we have a demand problem? Well, no, you wouldn't. You would now have to manage demand because you have a lower supply, but any action taken directed at demand would never solve the problem, because the problem is supply. You've got to go upstream and you've got to fix this problem. You have a supply constraint. You got to go and talk to them and say, look, we relied on this river and you put a dam up. We get that it goes through your region, but you're screwing us over. This is not a demand problem if this happens. This is a supply problem. It's a supply problem that creates the illusion of a demand problem, because now you need demand management to manage yourself down to that lower supply. But it's certainly not a demand problem if you can get rid of that dam. Well, we have a dam on supply. So do what you want to curtail demand over here. You're not going to fix the supply problem. Let's go to the auto companies again, the F-150. Just to give you an example here, and the Silverado. They sold out 4 minutes, 12 minutes, and they have what's called reservations. So not only are they sold out, but they have a whole bunch of people in line. They sold out, they have a whole bunch of people in line. Raise interest rates. Maybe this person drops out of the line, this person drops out of the line, a few people here give up their reservations, but the line just all moves up. You'll still have a line. And they'll still sell everything, and they'll still sell it at the price they can sell it at, and the price won't drop. You'll have just convinced some people that couldn't get it that they didn't want it anymore because of the price. You're just making them feel better about not getting what they want because, oh, I don't want it. If rates are going up and my financing costs are going to be this, I suddenly don't want it anymore. So I don't know that raising rates are ever going to get to the point, especially in the beginning, of solving this demand problem. So this scenario down here, I think, is one of those things where somebody in a circle said something and it went all around the circle and it came back as something completely different and completely ridiculous. I think this is what you're looking at over here, is that by March, I think that they'll be out of the bond buying program. Maybe you'll have a rate hike in March, but it will be measured and careful. 25 basis points. I think 3 over the course of the year probably makes sense. let's understand that that still doesn't get you to 1% on the short end of the curve. That still doesn't get you to 1%. Are you telling me that businesses are so fragile today that if interest rates went from almost zero to, let's say, 0.8 or 0.9 or even 1%, suddenly the whole edifice falls apart? Come on, come on. I don't believe that at all. I don't believe this scenario, and I think that's what the market is doing. Is you have all of these talking heads on Bloomberg and CNBC moving the ball down the field, moving the ball down the field. Starting with this scenario, somebody else coming on saying, well, it's incrementally a little bit more, and then everyone gets used to that as the baseline, and they say, okay, well, they anchor to that baseline, and then they'll adjust more from that baseline. Then they move up to there and go, okay, that sounds reasonable. And then you end up in a completely unreasonable place through a series of seemingly logical, reasonable steps. And that's where we are right now. Let's look at some economic data, and we'll look at a few other interesting charts as well. Okay, let's have a look at an economic calendar. We'll look at the last week, and we'll look at the week ahead as far as all of the links for everything that I'm going to show you. If you look at the first comment box under the video, that's where all of the links will be, and you can follow those. So this is the last 7 days, and you can select just the country or region that you want. So you can select whatever it is you want. I just have the US up right now because we're looking at S&P 500 as our sort of benchmark of how we feel about where things are going. And it highlights it in terms of low importance, medium, and high importance. The red ones are high importance, and we'll see next week that we got a whole bunch of economic events next week that we want to be aware of. Housing market index, 83 versus 84. This is a pricing index. I'm not too concerned about that. I don't really pay attention to what the Treasury is doing. Mortgage applications, 2.3%. Previous was 1.4. If you're taking out an application for a mortgage, a lot of people get pre-approved for mortgages before they go buying. So it is a half coincident, half leading indicator. So that's showing growth. Building permits, that's a leading indicator, 9.1%. And the last was revised. If you want to see more, you just click on it and it'll give you the trend. Look at that 9.1. If you look at over the last year, that's a huge jump. And building permit is a leading indicator because if you have an increase in building permits, you get a permit before you can actually start a house. So it gives you some idea of the demand for materials, the demand for construction labor. Things like that. Housing starts. This was for December, by the way. This is December. These were started 1.4%, and the last one was revised downwards. If we look at housing starts in December, we see that it's rather low. But whenever we're looking at something like this, you have to then think, well, hang on a second. Were there events that were an issue? So you have to look at what regions of the country contributed to lower or higher housing starts, and areas that have inclement weather or bad weather for a period of time, yeah, that'll take a hit, especially if it's a big major storm that has some continuing damage to it. Not only that, you have the December was Omicron everywhere you turn. This thing is contagious. We don't know anything about it. Well, at the margin, that's going to keep people home. So it's hard to start a house if you realize that, look, we're not going to be able to get the supply. The foundation has to be done first, and they're short of people, so it's going to be 45 days before they get to our area to pour foundations. You have to you got to look at that a little bit more, and you got to dig deep into well why was that? Now, if there were no supply constraints and no climate related issues for it, then you look at that, you say, well, there's an issue with demand. And maybe you would see something like that later in a rate hike cycle. So this I look at, I go, I can point to things in December that would have resulted in this anyway. So I'm not too concerned about this. Not only that, in a lot of northern regions, depending on the temperature, you're not going to be pouring foundations. Let's keep going. Building permits, 1.83 versus a forecast of 1.7. Housing starts, 1.7 for 1.65. This was in December. Continuing jobless claims are higher than expected, but I think we could expect that with COVID restrictions. And I know Ontario here in Canada, we're in lockdown till the 26th, that anybody who can work from home can work from home. Gyms, restaurants, things like that, are taking another hit. So that doesn't surprise me. This also doesn't surprise me either. 286 versus a forecast of 220. By the way, if you go back over time and you look at initial jobless claims, right around anything under 200,000 is really, really good. Anything over 400,000 is a cause for concern. In the middle is like, well, what was going on during the course of that week? 286. That's nothing that would cause a 9% pullback in the S&P. So I'm more apt to overlook that. Philly Fed, parts of this are leading indicators. You have 23.2. Some of the leading indicators in there are CapEx, and that came in higher. And I think new orders came in higher. So those are both this is called the diffusion index. So you have to sort of dig into this a bit more. But this gives you an explanation of what it is. And if you want to dig into it more, you can just Google Philly Fed Manufacturing Index, and it'll give you all of the components of it. Some of them are leading indicators. The CapEx came in stronger, and new orders came in stronger on this, and actual is 23.2 versus a forecast of 20, up from a previous of 15.4. Existing home sales have dropped, but again, that's for the month of December. That's a more coincident how many homes sold in December. And again, you have to go back to December. You can't just look at the data independently. You have to say, well, what context were we in December? You couldn't turn on any news outlet at any time on any channel without hearing Omicron repeated 30 times every 6 minutes. Existing home sales, this is negative 4.6, just gives you the number, 6.18 million. Still not too bad. The last number was revised upwards. So, in going through this is not painting a picture that supports the move in the market, right? I'm not trying to find, let's find the economic indicator that's causing this. I think I pretty much know what's causing this. I'm just looking at the economic indicator saying, could any one of these have been responsible for anything? And no, other than they're showing they're well within normal variation when they do miss or when they do beat. Leading index month over month for December, and this is a leading indicator. Actual 0.8%. The forecast is 0.8, which is fairly strong. And there we go for last week. Let's look at what's going on in the week ahead. Actually, we can just look at the next 7 days here. We got a lot going on. PMI for the U.S. This is Monday morning, 9:45. 56.7 is the forecast. Anything above that supports a growing economy. Anything over 50 for these types of indexes, anything over 50 is seen as growing. Anything under 50 is seen as contraction. So if it came in at 55, it might be lower than what the forecast was, but 55 is still growth. The housing price index, I don't find that to be too important. Consumer confidence, that's going to be important. This is for January. I don't know what to expect there. So we'll pay attention to that. The big stuff is coming up later in the week here. The goods trade balance, I never pay attention to these. It's just, if you're a dollar trader, if you're into, the Forex, then yeah, this is probably going to have some effect on the U.S., although, nothing is surprising. You've had a trade deficit for how many decades in a row? Like, it's not going to change. I can tell you right now, it's going to be a deficit. All right, that I know. New home sales, that'll be interesting to see. Here's the big one. the Fed rate, interest rate decision. Previous was 0.25, forecast is 0.25. They're not expecting any rate change. I don't expect a rate change. A rate change would be huge. If they hiked rates at this meeting, that is huge. Yeah, you could see some downside. As the initial reaction, I think you would see some downside on that. But this is going to be an important meeting because the statement after is going to be important. And how much do they curtail bond buying by? Do they just say we're out of the bond buying business and it's over? I think that would be seen as supporting 9 rate hikes or 8 rate hikes this year. But if they just cut it back 10 or 15 billion, little steps like that, I think the market will say, oh, well, hang on a second. I think we got carried away here. The original scenario that we painted out, a rate hike maybe in March, but out of the bond buying by March seems reasonable. Definitely a rate hike by June, maybe 2 more, maybe 3 or 4 during the year, and that's about it. I think they understand this is a supply problem, and I think they understand that time will fix the supply problem, but they can't be seen as sitting on their hands. So they got to do something, but I think what they're going to do will be token things. Just to say, well, look, we did something, right? And if time will solve this problem and they take time to do their things, they then may be able to claim credit for it. Meanwhile, it was just time. This is going to be the big one. And this is going to happen on Wednesday, I believe, the 26th. Yeah, where are we today? 23rd? Yeah, so this is Wednesday. It's always a Wednesday. I don't know why I stopped to look at the calendar. So this will happen Wednesday. It will be the big event. I would not look for the market to make really dramatic moves before Wednesday. I think on the downside, it's going to find support at its 10% correction level, which is 43.22. I don't see a big sustained move below that before we hear what these guys have to say, or these people. Let's just use a more generic term. What these people have to say. I also don't see a rally, a relief rally, and saying, oh, this is overblown and overdone. Until we hear what these people have to say. So I think if you are uncomfortable with where the market is right now, you're going to have to be uncomfortable for a couple more days. And just say, well, look, I'm not expecting anything really major. Which means, what am I going to do? I am certainly not taking on any new risk positions in front of this. I may change my risk profiles. I may say, well, you know what, instead of holding 10,000 shares of this particular stock, let me go down to 8,000 shares and I'll replace the 2,000 shares I sold with 20 in-the-money call contracts that have a very low time value component. Maybe I'll do that to protect myself on the downside. So I may change the form of my delta as opposed to being just straight long. I may reposition and reduce risk in certain areas. I may do that, but I'm certainly not going to say, I've had my eye on this stock for a while. Let's take an opening position of 50,000 shares. I'm certainly not going to do that. I like to know what I'm getting into, and I want to hear what these guys have to say, and I'm pretty sure it's going to lean more towards the, I thought you guys were going to do all of this stuff, and it doesn't seem like you are. And I think we'll go from there. I think bonds probably could, if I'm right, I'd be looking for a bond rally into Friday, and I'd be looking for a market rally into Friday with the realization that, this is not too bad. Now, let me qualify that. We have 104 S&P companies reporting earnings over the course of the week. I think that the reaction will be muted at the market level for that. But if earnings are good and the Fed moves just one little step, not a big step, but just one little step, that sort of suggests that, wait a minute, all of these 9 rate hikes, that's not going to happen, not with the way they're moving. Combined with good earnings, I think that the end of the week could be nice, but let's see what the tone of earnings are. Up until Wednesday, because we'll have Monday morning, Monday night, Tuesday morning, Tuesday night, and Wednesday morning. You'll have a whole bunch of companies reporting. You'll have the Fed in the afternoon, and if the tone of earnings was good and the Fed is far less hawkish than the market is priced in, then I think that, yeah, I think we're okay. Then on the 27th here, you have durable good orders and growth rate quarter over quarter for Q4. I don't know that this will have much effect after this. This will be the big thing. This will set the tone. Whereas this, I think, will be overshadowed by what's going on here. And then you have the big number on January 28th, the consumer expenditure price index, the core consumer price, personal consumption expenditure price index. And it's issued as an index. I think the base year, the 100-year is 2012. Before that, it's lower. After that, it's higher. So if you don't like reading as an index, it does have the quarter over quarter. Well, this will be year over year. Forecast 4.8%. Is that high? So I look at that and I say, well, let me put that into context. I'd like to see what that looks like compared to previous years in terms of what the inflation is. I personally think that if you take a baseline of about 1 to 1.5% off this 4.8, so let's take 1.5% and go to 3.3, and let's say that 1.5 is just the natural flow of inflation. So you can't compare 4.8 to 0. You have to compare the 4.8 to 1.3 or to 1.5. And let's say with 1.5 is the natural flow of inflation. We're 3.3 percentage points higher than that. I'm of the belief that at least 75% of that has to do with supply, if not more, 75% of that. So you're about 2.4 to 2.5% of that 3.3 that interest rates and monetary policy can do nothing about. And I think they're aware of that as well. So if you take the baseline of 1.5 and then the difference between 3.3 and 2.5, which is 0.8, you get to 2.3% of that 4.8%, which the Fed can do something about with interest rates, but the rest they cannot. It is not a question of having more restrictive monetary policy to solve inflation. It is an aspect now of having less restrictive COVID policies, and that's what you need to solve the inflation problem. Let's have a look at this index over a period of time. Actually, we'll look at it in terms of the percentage. Okay, this is the Federal Reserve economic data. Whenever you're using any data, always look at the source of where you're getting it. You want to try to get as reliable a source as you can. And this is going back all the way to, I think, early 1960s. We don't have to go back that far. What is this over here? That is a massive jump in inflation. If anyone is old enough, I was a kid at this time, but if anyone's old enough, you'd remember this, or if you understand your history, that's the oil embargo. So that level of inflation, was that demand driven or supply induced? It was supply induced. And look how quickly it went up. When you cut off supply, it goes up. Demand driven inflation looks like this over here. See this period of time? Look how it's creeping up and creeping up and creeping up, right? Supply induced inflation has these big sharp jumps to them. Because again, let's think about the river and the amount of water going through. Well, a whole bunch of people just don't show up in a new community, but over time a community can grow. And as it grows and grows and grows, it puts more and more demand on the existing water supply. So we find that you get a constrained amount of water over a longer period of time when it's demand induced. But as soon as you build a dam, you turn off the supply. The problem happens right away. So whenever you have supply induced inflation, it tends to have these big jumps very, very quickly. Big jumps, and then it solves. And of course, here we go again. This was the second oil embargo in the late 70s, and then down we come, right? Now you could say, well, it was Paul Volcker doing it, was it? Was it Volcker doing it, or was it a lot of he pulled back a whole bunch of demand to create a recession, but were supply problems solving themselves at the same time? And over here, this again, I'm arguing is supply constraint. Look at the sharp rise up. And if we go back to normal ranges, 1% to 2%, this is all in between 1% to 2%. So I'm saying if you take the last decade here, and you take 1.5 as your baseline, and you're at 4.8, there's really only 3.3% that you're going to be able to work with. And of that 3.3, I believe 75% is a supply problem, if not more, is a supply problem, not a demand problem. I don't think that those people inside the central bank believe it to be any different either. They're smart people. I'm sure they can see it, but I'm sure they also understand optics. And they have to be seen as doing something to create confidence in the investor community that inflation is not going to become a problem. So they have to do something, but this is not what they're doing. I don't believe is action taken to solve the inflation problem. I think it's action taken to solve the confidence about the inflation problem, which means I don't think they're going to be as hawkish as 9 rate hikes and canceling the bond buying and raising rates 50 basis points at a time. That's the last one I heard. 50 basis point raise is their first move. It's come on. I just, I'm not saying it can't happen. It's just, the market is a game of probabilities, and you have to put probabilities on things. And I look at that and I say, I place a low probability on that based on my experience and my interpretation of events. And I don't think that I have a monopoly on clarity. I'm pretty sure that they're well aware of this, but I don't know that they can come out to the public and say, what do you want us to do? This is a supply problem. There's nothing we can do. Well, then suddenly you run the risk of a wage price spiral of workers saying, I'm not going back to work unless I'm getting this much money, and they get that much money, and companies have to raise prices for that, where the new round of workers say, well, now I need so much more. And then on it goes. I think that's what they want to try to avoid as best they can. So this is optics. And I'm pretty sure they're aware that this is optics. One analyst, which sort of is on that side as well, is saying, I would not look for a lot of open market operations. This is action the Fed actually takes. He says, what you're going to see is a lot of open mouth operations. Meaning that they're going to talk down inflation as much as they can, because they probably are aware that action isn't going to do as much, but you got to do something for confidence. So they're going to do just enough for confidence and hope that time solves this problem. Let's look at earnings. We've had some companies report earnings. Could that be a problem right now? So far, from the economic perspective, I can't justify the sell-off. Okay, so I can eliminate that. From a geopolitical perspective, I can't justify the sell-off, but I can explain some movement in prices of commodities because of it, because geopolitics typically affects commodities and currencies more than they affect particular markets themselves. So the fiscal, paying people to stay home. The monetary, I don't know so much that the monetary can solve the problem, but the belief that the monetary will attempt to solve the problem, I think, is the big cause for this sell-off right now. But could earnings have something to do about it? So let's have a look at that. Okay, as far as the source here, IBES data from Refinitiv, again, the link for this, it's a long PDF. The link for it is right in the first description box. If you click on it, you'll get to, I think it's 20-30 pages. There's a lot in there. We'll look at a few more charts from it as well. This is a Q4 2021 earnings scorecard. January is earnings month, and this is earnings from the last quarter, from Q4 of 2021 being reported now. 64 companies have reported to date, 64 with 76.6% of it above analyst estimates. Okay, well then, I could see if 12% were above analyst estimates and there were a bunch of misses, I would say, well, that's a problem. But 76.6 above analyst estimates, that's in line with long-term averages of how many companies beat estimates. You got 104 companies reporting the week of January 24th. So we got a big week ahead of us. You got some big economic data. You got inflation, you got GDP, first look at GDP, you got the Fed decision, and 104 companies reporting earnings. Big week coming up, which I think will probably set direction for a while, with the Fed being the big one. Let's look at what's going on here. It's broken down by sector, so we can see consumer staples, discretionary energy, financials. Look at industrials here. This is the number of companies reporting that were above expectations, 100% in industrials. Beating by 15.9%. 10 companies reported, 10 companies knocked it out of the park, and not only knocked it out of the park, but beat on average by almost 16%. That's huge. Look at communication. Well, only one company, so you can't read too much into that. You want to look where there's a bunch of companies. 28 in financials. Surprise factor by 5.3% with 71.4% above. So these are all rather in line. Consumer staples, 57.1%. Surprise factor, 5.4. This is the stuff you buy every single day. That if I were going to be constrained by the environment, I probably may not go to the supermarket as many times as I want, or I might just delay some of these small little things for a while. But if I want a new vehicle, I'm going to get a new vehicle, right? Consumer discretionary. 5.5%, 66.7% above. This is stuff they don't have to buy, but they do. And this is stuff you think they normally have to buy. So there's some digging around in there. Who are the 7 companies, right? There's not that much to look at, but it still gives us some idea. All of these are over 50%. Some of these categories that only have 1 in there, I would just ignore that right now. But 64 reporting, 76.6% above. You got 104 to report next week. All right, index sitting 44.82.73 right now. 44.22 is the 10% correction mark. So you're 60 points above. I don't know why we wouldn't touch it at least. I think we would, just to say that it's in the record books and it's done. If we look at earnings trailing 12 months, market is now trading at 21.7 times versus a long-term average of 19.6, by the way. Or sorry, not a long-term average. I think this is the recent 10 or 20-year average, not a long-term average. EPS in last year, this is based on EPS of 206.41. The expected EPS over the 2022 is 223.66. So given this price, next 12 months has a multiple of 20. And this is another chart from that report, which you have the link below. This is what's being reported right now is this quarter. We're expecting revenue to be 12%, 12.4% over Q4 of 2020. And for earnings to be 23.7% above. And this is the forecast for 2022. So we'll learn this in April, we'll learn this in June, we'll learn this in October, and we will learn that next January. But here's the forecast. Still growth. I mean, you still have growth going on, albeit lower growth. So do we need a lower, potentially lower multiple on the index? Well, we do have one now. We've gone from, I think, 23 and change down to 21, and the forward has gone down to 20. So we've knocked 2 multiples off the index. Do we need to knock more? If you listen to a guy named Jeremy Grantham, he's saying, "Oh, we are in a massive bubble," and he's famous for calling a whole bunch of bubbles. But he's also famous for calling a whole bunch of other things that never actually happened. And I'll show you the list of all of the calls that he made that never happened. So let's say that I stand outside my house every day and I scream to my neighborhood, "There is a massive thunderstorm coming," and I do that every single day. I'm going to be right. And then when I'm right, am I going to be on the news saying, this is the guy who called it? Long before the weatherman called it, this is the guy who called it. Yeah, but I called it every single day. If every single year I'm calling for a crash in the markets, when one happens, am I right? Or was I just crazy long enough, right? So we'll look at what's going on with this guy here. Bears are right 20% of the time. Does that make them smart because they were right 20% of the time? And listen, I can know nothing about markets, but say markets are going up this month, and I'll be right 75% of the time. Does that make me smart? Right? So let's just be careful about these predictions. Somebody says, "Oh, he predicted this." Yes, but he predicted it 29 times. So it happened once, predicted it 29 times. Come on. Look at the forecast again. It's positive. And I did a video a while back looking at what my forecast for 2022 was. And I did say that, look, earnings are going to be muted. I don't think you're going to have earnings making up 12% of GDP anymore. I think that it'll start to retreat back to its 6% level, which is a mean reverting level. But I think much of that will be given up to wages, which is good. It's healthier for the economy because you'll have higher volume on the top end. So I don't see 2022 as a negative year. I was just thinking that you're gonna get some gains out of the index. And now, mind you, this is not deterministic. This is all probabilistic, and this is just my belief. Is that I think we do go higher, but certainly not by leaps and bounds, and certainly not without volatility. But I think that we can end the year probably 6, 7, 8% higher than we started the year. Certainly not the 20-some over the 25-some percent that we had in the S&P last year. And if you include dividends in the returns, 26, 27, 28% on the S&P. I don't think that's in the cards. It just doesn't feel that way. I could not make the case for it, which means the probability I'm assigning to that is very low. Now, there's a difference between probability and possibility. Just because something is not probable doesn't mean it's not possible. Just you may assign a 2% probability to something, but that means every 100 times it'll show up twice. It is possible, it's just not probable. So I'm not saying it's impossible to have another 25% year. It's just improbable. Its probability is very low. My heavier probability is towards an up year, but very muted. Nothing really to get excited about, but when you are forecasting, you can forecast returns and you can forecast volatility. So I'm forecasting that as returns. As far as underlying volatility, I don't think it'll be a calm year. I think it'll be heightened volatility with muted returns. So if you're an options trader, it's going to be a great year. You can still walk away with some good income with options trading. But if you're a long-only investor, well, get used to volatility, and for all of that roller coaster ride, you're going to come out just a little bit ahead if you have the fortitude to stay in the market. So this is the forecast for 2022. There's the aggregate right there, 6.7% revenue growth over the previous year, 8.2% earnings growth. I believe that you do have the potential for this to increase over the year if we slowly start seeing, or even quickly start seeing, supply bottlenecks improving, or supply constraints improving. Not the bottleneck improving, the bottlenecks degrading, meaning supply constraints improving. That if supply conditions start to improve and we get back to a more seamless supply channel, I think that you could probably start saying, if most of that inflation have gone to wages and supply begins to improve, I think over the course of the year you might actually see these estimates increase over the course of the year. I'd assign a higher probability to that than a probability of a great year. And if I start assigning a higher probability to that and I start seeing that, well then, Bayes' theorem, right? You go and you update your prior probabilities. I'd probably update my probability of the market returning, over 10% to a little bit higher than it being under 10%. Let's go look at Exhibit 18A. These are positive predicted surprises for the earnings that are coming up over the next week. Okay, 18A, positive predicted surprises for January 24th through to February 4th. So it is more than just the next week. I think that February 4th goes to the following Wednesday. It shouldn't surprise you that energy is dominating. Exxon, Phillips, ConocoPhillips, Valero, and materials here, Freeport, Macmoran. And this is just a forecast, right? This is the estimate, the smart estimate, and they explain how they arrive at this smart estimate up here, how they weight it, and it's not theirs. They're just looking at all of the other analysts, and they weight the analysts based on how right they've been in the past. Let's see if we can figure it out. It's a weighted average of analyst estimates with more weight given to more recent estimates and more accurate analysts. So they don't just say, well, 29 analysts have this estimate. They say, well, wait a minute, all these analysts are not equal. Some of these estimates are more current. Let's give more weight to that than somebody who estimated it 6 months ago. And let's give more weight to those who have a better track record. Yeah, that makes a lot of sense, right? And this is what they get to for Exxon 197. The mean is, if you just take the mean without waiting for time, recency and accuracy, you get 1.86. So they're predicting a surprise. And they tell you how good this is as well. It says here, the predicted surprise accurately predicts the direction of earnings surprises or further revisions 70% of the time. When a significant predicted surprise for revenue is also present, the accuracy improves to 78%. So if you're playing probabilities, that's what you're looking for, right? You're looking for that edge. So it gives you the name of the company, their date that they're reporting, Tesla, January 26th, 253. An estimate 253 versus 231, and there's I'm not looking at this in terms of, well, what is this going to tell me about the direction of the market. I'm looking at it in terms of, do I have any names on this list, and of the names I have, if they're not on this list, where are they? And of course, I then have to weight the idea of, well, it is just some other company's opinion. It doesn't mean that this is actually going to happen. They're right 70% of the time, they say. So, but still, it's just, I just want to know if I have any exposure here. And if we scroll down here, we have General Motors and we have Ford. 47 cents for Ford versus 44. 6.9% surprise on the upside. GM, 6.1% surprise on the upside. I've got exposure to those. So I'm going to want to, be aware that this doesn't threaten me. Now, if the estimate was way below for both of them, I would then be thinking, well, what am I missing? Maybe I might be induced to do some risk management at this point. But this is in line with my beliefs as it is. So I'm thinking, well, okay, so I'm not going to bolster my belief about GM. This doesn't threaten my existing belief right now. So I'm not too concerned about that. As you keep scrolling down, you can get to negative predicted surprises, and these are the companies that will have negative predicted surprises. You can see here, Sherwin-Williams 135 versus the expectation of 145. So if you have any companies on this particular list, you might want to be aware that 70% of the time they're right, but 30% of the time they're wrong. We keep going. Earnings calendar. January 24th, 25th, 26th. It tells you what sectors are going to be reporting, and it's a mixture across all the sectors. Consumer discretionary 60. Whereas the industrials down here, 72 of them. Remember now that it had the highest earnings surprise and 100% beat. So with industrials, I think that we pay a lot of attention here. We're not going to get much till the 25th, with Thursday being the big one. Our central bank is the 26th. Yeah, that's the 26th, and then you have a whole bunch in behind it. So we don't have a bunch of companies reporting before. We may not get a very good tenor or tone. on earnings ahead of that meeting. A lot of it is near the end of the week. You can see down here, 36 on 4 and 16 in front of the meeting, maybe 18 and 18 before and after, 38.10. Monday morning earnings calendar, if you keep going, it'll tell you who's reporting Monday before the open. We have Tuesday, January 25th. We have Wednesday. Yeah, and it just keeps going. I'll let you explore this document. The link is below. Okay, this is from the Irrelevant Investor, and the link is below. One of the great bubbles of financial history, as Jeremy Grantham has said, this is the lead-in. He's famous for calling the Japanese tech and housing bubbles. So when he speaks on the topic, investors pay attention. But it also, he says, this last line I like, it's only fair to point out that he has been bearish for much of the recent bull market. 2010, have cash, wait for stocks to fall. 2011, Grantham sees most global equities as ranging from unattractive to very unattractive, valuing at the S&P at no more than 950. It never went back to 950. 2012, the very next year, 2013 will be a dangerous year for stocks. It wasn't. 2013, much of everything else is once again brutally overpriced. Next year, what did he say? Big stock bubble will end badly in 2016. What did he say in 2015? Markets are ripe for a major decline in 2016. So if you scream this every single year, at some point you're going to be right. So if from the time he was born, he screamed the market's going to crash, then you could say, yeah, he called the tech bubble, he called the Japanese bubble, he called the housing bubble, he called them all, but he didn't, he called it every single year. So, what's his hit ratio on that one? If you're calling it every year and you're right once every 10 years, you will be. 10% of the time you're right, 90% you're wrong. Do you listen to that? Here's, I think this is really interesting. It says here, okay, you get the point. After 2015, Grantham softened up a bit and wrote an introspective piece in Barron's. And this is what he wrote. I consider myself a bubble historian and one who is eager to see one form and break. I have often said that they're the only real important events in investing. I have come to believe, however, very reluctantly, that we bubble historians have, together with much of the market, been a bit brainwashed by our exposure in the last 30 years to 4 of the perhaps 6 or 8 great investment bubbles in history. So he's basically saying, you know what, maybe it's me, maybe I'm the problem. So this was what he wrote here. It's a good read. It's interesting. The link is in the comment box below. Sorry, I wasn't done with this one. The whole point of his article here is not to beat up on Grantham. It was to point out the problem with using the CAPE ratio in the data series that it has, and his argument is that you can't look at this red line as the average of where it should be and say, oh, we're 2 standard deviations above, because we certainly don't live in the same economy we did from 1880 to say like 1950. So he makes the case that you got to get rid of this part of the distribution. Nobody really cares about that, and it's not relevant for today because you lived in a world of diminishing returns to scale. But we don't live in a world of diminishing returns to scale. We can either have constant or even increasing returns to scale, which means that over time, the multiple at which you will buy earnings ought to increase over time. So that, even with this big drawback, he makes the point of it barely just touched the long-term average before bouncing right back off. It stayed there for like a minute before it went on. So that all of this stuff you see under the curve here, you don't see it here. So we're in a new regime. His argument is you got to cut it off and you got to say, well, maybe the new ratio has to have a reset instead of having this average that goes all the way back to 1880. Do you really think that the conditions under which earnings were made in 1880 are the conditions under which earnings are made today? So I do recommend you reading through this entire article. It's actually very, very interesting. And finally, I'm going to show you an interesting site that I like to visit, Morningstar. You don't get all of their data without a subscription, and if you are going to subscribe, don't look for a price. You're not going to find the price. The price is hidden behind a long process by which they first gather all of your data. Sign up for a free trial and give us a whole bunch of information about you, including your credit card number. Oh, don't worry, it's a free trial. And give us your credit card number, and then later on, if we're ready, we'll tell you what the price of a subscription is. It's quite frustrating. You know what? Everybody wants to capture your information these days. I bought an outdoor TV, one of these TVs that can survive in like plus 40 degrees Celsius all the way down to negative 20, 25. And you first turn it on and it says, it doesn't turn on. It starts with a screen that says, open your new account. It's a TV, so you got to open an account. What's your name? This, that, all this. It was like a half-hour process of all the information they wanted, but you had to go through all the screens before you could just simply go to the PBS NewsHour. That was all I wanted. But no. Everybody wants to capture information about you now, so you have to go on this first date with them and spill your whole history and biography onto the screen before they even let you look at the price that they want to charge you for stuff. I'm telling you. You know what we should have, and I really wish we did, is that you'd fill out your profile and all your personal information once, and every time you logged in somewhere, you could say, here you go. Here's everything that you need. Why do I have to type this out every single time? Why do you want my phone number? Required field. You can't get past it. Why do you want it? Well, of course, we're going to send you text messages to market, to market you for more product. We're going to send you emails to market you for more product. If you don't respond to that, we're going to call you on the phone. We're never going to leave you alone. So do I sound frustrated? I'm just tired of every time having to go through this first date where I have to tell them everything about myself just to figure out whether or not I want to even buy their product. Anyways, the free stuff is not too bad. You click here on the US and it'll give you the US. It gives you some, I like this little chart. At a glance, I can see at a very high level. This is if you have been through level 3 and you're looking at how you classify your portfolio, you have what's called the style box, the Morningstar style box. This is what it is right here. So large cap value down 1.1%, but you can see growth really took some punishment in the last day. So we do seem to have a rotation out of growth into value. Why is value down? Why are some good companies down? Why are companies that have PEs of 8 or 9 selling off? About 50% of all of the volume on most indexes is algorithmically driven. It is an unintuitive algorithm that is just responding to moves in the market. So it's quantitatively determining that, well, there's internal weakness, so there'll be weakness here because of this correlation, and simply just selling. It's not interested in owning companies. It's interested in capturing gains. So it just executes according to an algorithm. It does not represent the sentiment of a human. It represents profit seeking of an algorithm. About 50%. So good stuff tends to get thrown out more and more with these sell-offs, which is a great environment to be in if you're a value investor and you're looking to buy stuff that, well, why are you throwing this out? It had a multiple of 7.5, and now you've traded it down to a multiple of 6. I'll take it, thank you, right? So that's why the value, large cap value, is also selling off, as well as just I think a lot of it is the lack of a human being standing there going, whoa, I can see selling the other stuff, but this, the algorithm would just say, there's money to be made, get out of my way. You can look at it over the past year, and we can see small cap growth has just not done well over the last year. If you look at where the Russell 2000 has gone over the last year, it has not participated in any rally. So if we were looking for a breakdown in any of the indexes, it probably would have been the Russell breaking down below its support lines. Look at small cap value over here. Where are you going to find these guys? The S&P 600. If you want to look for profitable small cap companies, the S&P 600 is a barometer for that. You can look at the performance of the S&P 600 versus the Russell 2000. Big difference between the two. And this is over the last year, the last 3 years, the last 5 years. I don't know that this is relevant really. The last year I think is important. The day just gives you a very high level view of, okay, well, what in terms of style, what's happening, and it looks like no to growth, yes to value in terms of outperformance. And here is the globe over the last day. Not a lot of places to hide. Over the last year, it looked a little bit better. 3 years and 5 years. So it gives you some idea. Cyclicals, what's sold off. Basic materials, consumer cyclical. It gives you the percentage. You can look at sensitive industries. You can look at defensive, consumer defensive. Hardly move that much. Healthcare, utilities. Utilities don't really go down very much, but they don't go up very much either. You have active. You have your gainers. You have your losers, and that should not be a surprise to anybody. That was a big dump downwards on Netflix. And, you can keep, there's a whole bunch of things you can look at, the earnings calendar, economic reports calendar, splits calendar, IPO calendar, all by briefing.com, or you could just go to briefing.com on your own as opposed to viewing it through the lens of Morningstar. And you can play around. There's a whole bunch of stuff along the top that you can look at. They have different topics that you can visit. And you can get 14 days free. By the way, if you want to know how much a subscription costs, that's the only door. You have to go through that, and you have to give them a bunch of personal information and take a whole bunch of pledges and promise never to talk about anything you ever see. And then maybe somebody will call you 27 times and tell you what the price is. So there we are for Morningstar. All right, let's sum up what we have in terms of what I plan to do this week. Nothing. Oftentimes it's better to sit on your hands than to do anything. I'm probably not going to open up any new positions on anything until I hear what the Fed has to say, because that is everything. The market really doesn't open till Wednesday afternoon at 2. I'm going to consider everything that happens before it as pre-market. And I'm just not going to trade in the pre-market. I'm going to pay attention to earnings and the companies that are reporting, not because I'm interested in the companies, but I'm interested in what the outcomes are in terms of performing above expectations, in line, and then paying attention to guidance. And then, of course, the market reaction to them. I don't know that I'll buy too much into it, simply because, as I said, I don't think the market really opens until Wednesday at 2. And I think a lot of professionals are going to pull their bids and just hold back. I think we probably would sometime before Wednesday test the 43.22 on the S&P, 60 points down, maybe right out of the gate on Monday morning, without anything more than Friday's results. The idea that we're 60 points above the 10% correction point might be enough to cause a lot of participants to move their bids down to 43.20, 43.25, and if they move all their bids down, there's nothing but air all the way down there. So, would I be surprised to see a move down to 43.20? Nope, I would not. But at 43.20, I probably would begin to add to some of my S&P position in terms of a risk reversal or selling puts, or even maybe put a bull spread, a call spread on the index for probably not February, but for March. But beyond that, I certainly wouldn't be looking at increasing my risk exposure. I might transform some of my risk exposure. So one thing that I would consider doing is I have GM shares, a lot of GM shares, And if I want to change my risk exposure, let me just explain how I would do that easily. If I sell 100 GM, I can move into the March 40s, $40 calls. I sell 100 shares of GM, I free up call it $5,300, and I move into the March 40 calls. I think it's it would cost me $13.75. So I just transform the type of risk that I have, and I think if I can remember correctly, the delta on this was like 0.94. So I'd be getting a fairly good delta on that one. And it still gives me the same exposure. If GM fell another $2, this would drop another $2 as well. It's just it would begin to manage some of the margin exposure that I have. So I may, depending on the action that we have, I may transform my risk, but I'm certainly not going to increase my risk. I'd probably maintain the same amount of delta, just the delta would be in a different form. That's about the extent that I would do, but beyond that, I don't think that I'd be opening up any positions. On Wednesday at 2, I expect the Fed to be far more dovish than it is expected to be hawkish. The Fed will move and do something, but I don't think it'll be anywhere near the dire predictions we had on Friday of 50 basis point rate hike, complete abandonment of the bond buying, and I've even heard quantitative tightening (QT) that not only will they abandon the bond purchases, but they'll actually start to sell some of the bonds that they have on their balance sheet. No, I think that is overblown. Then we'll see, if earnings and the Fed statement are in alignment with my belief, then I'm going to lean very heavily into the S&P in terms of increasing my delta exposure very quickly. And I'm not quite sure which strategy I'll use for that. I like risk reversals, but they do require a lot of margin. The buying calls and the call spreads require less margin, but they have less upside. I don't know. I'll see how I feel when we get to Wednesday. And, a lot of what you do is a matter of, I want these types of risk exposures, number one. Number two, I have 3 or 4 ways to get those risk exposures, and I'll figure it out when I get there. But what I won't have to figure out is if earnings come in line with what last week was, 66, 67, 68% beating. If the Fed is far, far more dovish than the market is thinking, then yes, by the end of Wednesday day, I will be leaning in to delta on the S&P. And that is basically what I go through on a Sunday morning. It takes me a lot more time. I look at a lot more things. Sometimes you read things and you say, that doesn't change anything and it doesn't help me. Other times you'll read things going, well, okay, I can see where I would want to be a bit more cautious on this. Or this isn't really going to be a problem. It's very rarely that I get to a Sunday and I realize that, oh my God, I'm in a lot of trouble and I need to get out of everything right now. It's very rare that happens. It's more or less, do I need to adjust and what do I need to do? And doing nothing is a good conclusion, by the way. Too many people sitting in front of their screens feel they need their hands moving. They need to do something. They see something move and they think, well, I should be doing something. I should be taking advantage of this. In front of a big event like the Fed, especially now when this sell-off has been market participant induced based on this magnification of this opinion about what the Fed is going to do, this then becomes a very pivotal meeting because it will then snap this expectation back into line with where the Fed actually is. I don't know if this was useful or not. I thought I'd try a different approach because I've been asked, can you walk us through how you think about things on a, when you do this on a Sunday? And I thought, well, it's, there's nothing really magical about it or mysterious about it. It really is pretty much what anybody would do. So if it was useful, if it was helpful, say so. I don't mind doing this on a regular basis. Every Sunday, sort of just giving my opinion. But please understand, it's my opinion, and I am not 100% right. Much like the probabilities, I have a high probability, but I also am wrong often enough that you certainly don't want to just take one or two things I say and say, oh, I'm going to run with this or I'm going to run with that. There are certain things that, even in the options course, I tell you, look, I'm not playing this, but if I was, this is what I see. This is my interpretation. That doesn't mean I'm right. I try to be right by waiting for confirmation. Betting in front of something like the Fed is a bet. That's not a smart investment. It's just a bet. You're betting on a binary event. I don't like binary events. Anyways, there we are. I hope that was, out of the time I took from you here, I think an hour and a half. I hope you got some value out of that.